Welcome all to the session on corporate finance. So through this video, you will get exposures related to functions of corporate finance, objectives of corporate finance and the principles of corporate finance. Let us start with the functions of corporate finance. So the first function is acquisition of the resources. So how a company acquires the resources that is required? There is two ways in which a company can go for acquiring their resources. The first one is by the way of equity and the second one is by the way of debentures or bonds. Equity shareholders of a company are generally called as the owners of the company and it is related to an ownership. So equity is a ownership related instrument. The debentures or bonds, it's a creditorship related instrument. So these people can be considered as the creditors of company. So a company may raise equity from a general public or a company may sell the shares to possibly a very big private equity investor or to an angel investor or maybe the people who are interested to help up a startup. So through this way, a company can raise equity shares. Then by the way of debentures, a company can sell their debenture instrument or bonds again as a private placement to the institutional investors or to the retail investors like us. So by this way also they can raise the money. But we should understand that by the way of debentures or bonds, when the money is being raised, there is a very big commitment that you have to pay the interest rate on the agreed terms at the agreed frequency. But when it comes to equity, it's needless to say that a company may pay dividend or may not pay dividend. It's all based on the financial performance of the company and also, right, what they are going to do with the profits of that company. Okay, so this is related to acquisition of resources. The next function to discuss is allocation of resources. So now the money that is being raised through by the way of equity or by the way of debt instrument, this is going to be employed somewhere. So that's the reason a company has raised that money. So the allocation of resources can be into the fixed assets or maybe into the current assets. So if you are going to function on a day-to-day basis, there are certain current assets that is required for the company. For example, cash is required for that company. So the cash may be an inflow or the cash may be an outflow. When it is an inflow, automatically it is going to be an asset. When it is going to be an outflow, it is the liabilities that we are going to pay up. So the money that is being raised through the other resources is generally allotted to the current assets for the day-to-day functions. Then the fixed assets. So the fixed assets mean there are a lot of examples we have. So a company may be interested to expand their facility. So for that they may be constructing a new building, or they may be buying a new machinery that is going to be something most important for that company. So in that way, a company can employ the money that is being raised through the resources like equity or debt in buying the fixed assets. We should understand here that the fixed assets requirement and also the fixed assets benefit is being spread for several years for that company. But whereas the current assets is for a very short term. Cash is not only the current asset a company usually uses. There are other kind of financial assets that is also possibly can be considered as a current asset of a company. In short, the current asset means it's like a short-term instrument where a company has employed their money. So a company has invested the excess money in a share capital of another company. The share capital can become a current asset for this company. Or the excess money may be parked in possibly a bank account which can earn the interest that can become a current asset. So any asset which is highly liquid, so can be considered as a current assets. So as of now we had discussed about the functions of corporate finance. Here comes the objectives of corporate finance. So the objectives of corporate finance can be discussed in two ways, from the long-term decisions perspective and the short-term decision perspective. The first decision that is being taken in long term is about the investment related options available for the firm. You see, a company may be having multiple projects in their hand, but which is going to be feasible or which is going to be viable for that company? So a company need to think from various perspectives. For example, we take an example of a company like ITC. So ITC is actually a cash-rich company, but still when they want to go for acquisition of another company, they will think in a way where they are going to raise the money. So are they going to raise that money from the existing resources of that company, or they are going to plan for acquiring resources elsewhere? So there is a need of money, whether it is going to be an internal source or it is going to be an external source. A company has to have a very clear idea when it comes to a decisions that is related to financing. So as said, when you raise money by the way of equity, right, it's been specified that nowhere the equity has to be returned by the way of dividend. But when you raise money by the way of debentures or other debt related instrument, there is a compulsion. It's like a contract that we have to pay interest at a regular frequency, and also there will be a maturity date. At that point of time, we have to return back the money that has been raised. When it comes to the dividend related decisions, so here comes the logic. So a company, after earning the profits called as earnings before interest and taxes, a company has to first pay the interest related expenses. And after that, so when we are discussing this itself, possibly it should be clear that when we are paying the interest, so which means automatically our profit is coming down, and for that profit only we are paying the taxes. So the money raised through debt instrument has a tax advantage. So now we are getting into a concept of earnings before taxes. So now we pay taxes. So now this becomes earnings after taxes. So after paying the taxes, whatever left can be distributed as dividend. But again, there is two people to which you have to pay dividends. The first people to pay dividends is preferred shareholders. Right? As the name itself implies, these people are given priority, so the preference shareholders. So it is like a fixed rate that is distributed each and every year. And the second part of dividend is actually given to the equity shareholders. So after giving for the preference shareholders, the term used is earnings available to equity shareholders. Again, here also the dividend is not completely distributed. Some part will go as retained earnings, some part will go as dividend. So here the decision of dividend is so important, because once you had given dividend to that company and the money has gone out, again sourcing of money may be difficult. So that is the reason company diverts certain money and keep it as retained earnings and into the reserves for their future purpose. So we had a discussion related to decision on investment, where to employ their money. There may be n number of projects, which is the best project, which has the most benefit for that company. So we have to choose in that way. Then the decision on financing, and finally we had a discussion on dividends. So next we can move on to the short-term decisions related to the objectives. So again, the money is going to be employed in a current asset or maybe in a current liability. So money that gets in, that is the inflows, get into the current assets part, and the money that flows out gets into the current liabilities part. Let us have possibly a brief discussion related to current assets. As already discussed, current asset includes anything that can be converted into cash at a very shorter span of time. So which means the asset here should be highly liquid. The cash available in bank, the cash available inside that company, it's a current asset. Or any kind of prepaid expenses the company has done, it becomes a current assets. Or any debtors. By the way of doing a credit sale, there will be people who are getting into your business as debtors. So these debtors can also be a current asset for your company. How you are going to manage these debtors? That is so important. So how fast a company can collect that money from the debtors, the cash can get into that company quickly. So next comes the current liabilities part. So in the current liabilities, it can be a short-term loan that is being raised by that company, or it may be like a overdraft facility that has been utilized in a bank, or it can be creditors. So similar to people buying products or services from a company on a credit basis, a company may also be buying certain services from the other players. So all those people have to be paid. So that becomes a current liability. Generally, those people are called as creditors of a company. So maximum time how a company thinks is the creditors should be paid later and the debtor should be collected earlier. So this is how the company thinks and manages such that the current inflow or maybe the cash related things, cash inflows is higher and the cash outflows will be lesser. So we had a discussion related to objectives of corporate finance. Then comes the principles of corporate finance. So here again the decisions can be classified into investment decision, financing decision, dividend decision and liquidity related decisions. The first one is again investment related decisions. Okay, now let us have a practical example that is related to investment decisions. Okay, a company called as Tata Global Beverages, they even acquired Tata Coffee and now they have become a big company like Tata Consumer Products. So, the Tata Consumer Products, even though they are a very big company, always they look around them. So, how organically we can grow or else how inorganically we can grow. So, continuously they think for where the investment can be made. So now they are actually in a process of acquiring a brand that is related to foods. Like who is the best noodles manufacturer in the world? They want to buy a company which are doing it the best. They want to acquire that company and they want to integrate with a company like Tata Consumer Products. So a company can grow organically by expanding their products or they can grow inorganically by acquiring another company by the way of corporate restructuring like acquisition, mergers and other kind of things. So as said, the investment options available for a company is plenty. It is available all over. Next comes the decision that is related to financing. The same example we can take the Tata Consumer Products. They want to buy a global brand who are best at the noodles manufacturing and they want to enter into that specific sector. So now money is required, right, to finance this activity. So how this company is going to raise the money that is required for their financing related activity? Either the company may use the cash that is available. If the cash component is lesser, the company may appoint an investment banker to know how they can raise money that is required to finance this specific activity of acquiring another company. So this investment banker possibly may give an advice like you can go for a partial equity, you can go for a partial debt. So based on the advantages of going for equity and advantages of going for the debt related component. As I said, using of more and more debt, you are going to pay more and more of interest and obviously what is going to be left for the equity shareholder is going to be very, very less. Okay, so we had a discussion that is related to financing. And here comes the dividend related decisions. Once again, I am just reiterating. So, dividend is not compulsory. Okay, but when it comes to a preference shareholders also, right, when there is profit not available, we cannot distribute dividends. Then the next layer of people, that is equity shareholders. So, it's transparent that when nothing is available in the table, nothing can be given to these people. So, here in that investment decision, a company has to think about what they are going to do in the future. You see, in that future, if they are having much opportunities to grow, so for that opportunities, where they are going to source that money, whether it is going to be internal sources or whether it is going to be an external kind of sources. Always you should understand that external sources are not that easy. So there should be some internal sources for that company. So that is the reason whenever profit is being made and after giving the preference dividend, the companies generally think how much of money can be retained inside that company. Because they can fund the projects or they can fund the acquisitions that is going to happen for that company in the future. So some part is diverted as the retained earnings and some part is being provided as dividends. And again, when it comes to the dividend decisions, right, every year a company cannot pay a same kind of dividend, maybe in percentages or maybe classified in terms of a currency. They are not going to follow a same kind of policy. So the dividend decision is related to the dividend policy a company has. With this, we are going to conclude, that is liquidity related decisions. As said, a company should have enough liquidity to fund their current liabilities. So if there is a payment that has to be made by that company, and if they don't have enough cash in their hand, they cannot acknowledge that payment related activities. So a company should have some part of their assets as a liquid. So when it comes to liquid, it can be cash, it can be a money that is being available at the bank, a share, because share is highly liquid. If a company is going to sell a share, possibly in one trading day, a company can get back that money. So what are all the possible ways in which a company can keep, right, money or money related things, right, liquid? So that is most important, because a short term obligation of a company has to be met. So that is possible only by the way of liquid decisions or liquidity related decisions. So let us continue with possibly a stream of videos. Thank you.